Good morning. Today I will briefly introduce the Enron scandal and the Arthur Andersen audit field. Enron was a big U.S. energy company on the surface. It looked very successful, but actually they used a complicated structure called SPES to hide debit and make profits look better than they really were. Arthur Andersen was Enron's auditor, but they also made a lot of money from consulting Enron. This created a conflict of interest. Instead of being independent, they didn't report the real problems. In 2001, everything was exposed. Enron went bankrupt. Investors lost around $74 billion because of this. The government introduced new rules like the Urban Outlaws Act in 2002 to make sure auditors stay independent in the future. Our goal is to analyze how Arthur Andersen failed in this case. Now let's look at Enron Andersen's role as Enron's auditor. Arthur Andersen was hired to check Enron's financial reports and make sure they followed accounting rules, but at the same time, Andersen also earned a big consulting fee from Enron, about $25 million from audit, and $27 million from consulting. This created a serious conflict of interest, and Andersen didn't want to lose such a big client, so they become less independent and less objective. Because of this close financial relationship, Andersen failed to question Enron's risky accounting and complex financial structures. In the end, the lack of professional skepticism allowed Enron's fraud to continue without being detected for a long time. Now let's talk about the audit fields and the red flags in the Enron case. On the audit field side, Arthur Andersen ignored disclosures related to Special Purpose Entity, or SPES, which were used to hide debit. They also didn't properly test many transactions and failed to challenge Enron's aggressive way of recognizing revenue. There were also many red flags. First, Enron used very complex and unclear financial structures. Second, there was a clear conflict of interest between Enron's management and the audit firm because of the consulting fees. Lastly, Enron kept reporting very high profits, even though there was serious risk in their business. These warning signs should have raised doubles, but the auditor didn't act. Now I will explain how Enron's auditor violated a key auditing principle. First, integrity and objective was violated. Arthur Andersen allowed financial interests like high consulting fees to influence their judgment. Instead of being natural and fair, they preferred over proper auditing. Second, they broke the principle of independence. Auditors must stay independent from the company they audit. But Andersen's close financial relationship with Enron made it difficult to stay unbiased and challenge management's decisions. Finally, they failed in professional skepticism. Auditors should always question unusual financial results and investigate complex transactions, but Andersen accepted Enron's risky financial structure and aggressive revenue recognition without proper investigation. This violation seriously weakened the audit quality and allowed Enron's fraud to continue for the year. Now let's continue with two more violations of auditing principle. First is risk assessment field. Arthur Andersen failed to properly assess the risk related to Enron's complex financial structure and aggressive accounting methods. A proper risk assessment should have identified the high chance of fraud or misstatement, but Anderson underestimated this risk. Second is inadequate documentation. Auditors must carefully document their audit work, including the evidence they collect and the decisions they make. In Enron's case, Anderson didn't keep sufficient documentation to support their audit conclusion. Without proper records, it's difficult to prove that a thorough audit was actually done. Both of these fields weakened the audit process and allowed Enron's financial manipulation to go undetected for years.
So now let's talk about the ethical breaches by the auditor in this case. The first aspect is the ethical lapses. The International Federation of Accountants Code of Ethics for Professional Accountants lays out five fundamental principles: integrity, objectivity, professional competence and due care, confidentiality, and the professional behavior. But author Anderson's audit of Enron demonstrated clear violations of these principles. The first one is integrity. Anderson failed to present Enron's financial condition honestly. They compromised the integrity expected of auditors by signing off on misleading financial statements that included off-balance sheet entities. And next is about the objectivity and independence. Edison's audit staff maintained close relationships with Enron's executives, and they earned the substantial fees from both audit and consulting services. This compromised their ability to make impartial judgments. And the third thing is the professional competence and due care. Edison's auditor overlooked or failed to sufficiently scrutinize the highly aggressive accounting treatments, such as the use of market accounting and off-balance sheet financing. This kind treatment allowed Enron to hide their debit and inflate the profits. The last one is the professional behavior. The intentional destruction of audit documents during the SEC investigation reflected the behavior that not only violated professional standards but also significantly damaged the reputation of the profession. Another aspect is the pressure from the high-fee engagement. In high-fee engagement, the auditors may face the dilemma of either issuing unfavorable audit opinions and risking clients' loss or complying with the client demands to preserve the revenue. In Arthur Edison, they earned approximately $52 million annually from Enron, which half from auditing and half from consulting. And these dual responsibilities create a conflict of interest, which placed huge pressure on auditors to retain lucrative clients, even if it meant overlooking serious irregularities. This kind of pressure may have weakened professional skepticism and led to an unintentional overlooking of warning signs. So after Enron scandal, several key changes are implemented. I divided into two main aspects: the Sarbanes-Oxley Act 2002 and the establishment of the PCR. So for the SOX Act, the SOX introduced sweeping reforms to improve corporate accountability and oversight. There are three key regulations, Section 302, 404, and 802. So for Section 302, it requires senior executives to certify the accuracy of financial statements. For Section 404, it mandates the internal control reporting and external audit of internal control over financial reporting. And Section 802, it increases the penalties for destruction or falsification of records. Furthermore, the SOX prohibited the auditors from providing specific non-audit services like bookkeeping, system design, valuation, and internal audit outsourcing to their audit clients. And this reform was intended to eliminate the conflicts of interest and reinforce the auditor's independence, which is the key issue in the Enron Edison case. And the SOX also introduced the mandatory partner rotation every 5 years to prevent the overfamiliarity with the client. This can inject fresh perspective while maintaining firm continuity. And the SOX Act also marks the shift from voluntary compliance to enforced regulation. It replaced greater responsibility on both management and auditors. Another key change is the establishment of ACOP. PCOP is created to oversee the audits of public companies. The key functions include registering the audit firms, conducting regular inspections, setting auditing and quality control standards, and investigating and disciplining auditors. This oversight replaced the self-regulation model previously governed by the ACPI, and it aimed to enhance accountability and transparency. Additionally, the PCOP conducts the regular inspections of audit firms, especially those auditing more than 100 insurers annually, to ensure the consistent audit quality and compliance with the standards. So in conclusion, the Enron scandal was a pivotal moment in auditing history, which revealed the danger of compromised ethics, lack of independence, and inadequate oversight. And the author Anderson's complies underscored the consequences of ethical failure and weak regulatory frameworks. In response, such reforms like the SOX, the ban on certain non-audit services, and the creation of PCOP sought to rebuild the trust, enhance audit quality, and protect investors. This kind of reforms emphasize that the auditors are not just the service providers, but also the gatekeepers of financial integrity with the ethical and public responsibilities that must not be overshadowed by commercial interests. And that's all for our presentation. Thank you for watching.